is going to talk a little bit about the new tax law. Fabian is going to talk then about estate and taxes. I'm going to then talk about some IRA ideas, investing, and we'll kind of go from there. Hopefully have you out here between 1 and 1:15. This guy's not yours.
All right, so for tax smart investing, we thought we'd first start out with just a review of the new law, understanding what the law is. You probably recall the end of the 2017, lots of headlines floating around about what's proposed, but let's actually talk about what actually got enacted and what your CPA is doing for you right now. So officially it was called the Tax Cuts and Job Act of 2017. Objectives that they were trying to accomplish for individuals and families: lower the marginal tax brackets and rates. And then for businesses, similar, simplify, flatten the marginal tax rates and brackets, which Bob is going to end up talking about, but also turn it into a territorial system of taxation. Anyone know what that means? Probably a CPA might know what it means, but currently when large corporations, they're doing business overseas, the profits that they're generating, they typically keep them overseas because if they bring them back to the U.S., they're taxed. Therefore, large companies like Apple, Google, they're not bringing those profits back. And so they wanted to create a tax system that would incentivize those companies to bring that money back, create jobs, invest in technology. And so that was another one of the objectives out of this Tax Act. So let's jump in and take a look at the brackets and the rates. So first of all, 2017 over here, lowest rate 10%. 2018 didn't change, still 10% for low-income earners. Lowest bracket for 2017, or second lowest, is 15%. Dropped a little bit, down to 12%. So 3% decrease, actual 20% change in that bracket. Then 25% bracket dropped to 22%. 28 down to 24. Then as you get into 200, 250,000 in income, where your rate's going to be 33 or greater, didn't drop as much. It was 33, 35, 39 and a half. It's at 32, 35, and 37. So really where the significant changes were kind of in these middle brackets, middle class America. And then if we look at the dollars, the first brackets, no significant changes. Really where you see the changes are here here again in this third bracket, where previously the upper limit was 153,000. That jumped up to 165. So pretty significant increase for the middle income America. And then in the next bracket where the upper limit was 233, that jumped up to 315. So that's a pretty significant increase. So if you're in that, say 160,000 range, not only did you drop a bracket, you also dropped two rate increments. And so that's a pretty significant bracket. A year ago you would have been in 28, you would have dropped down to 22% if you would have been in that range. And then for the big wage earners, if you're at 470 or in that range, that actually jumped to 600,000. So otherwise, the upper brackets didn't change too significantly. Then on the standard deduction and personal exemptions, a year ago, for again, this is married taxpayers filing jointly. You got 12,700 for your standard deductions if you were itemizing, and personal exemption was 8,100 or 4,050 per person. So this isn't taking into account kids, just the married couple. Well, that changed in 2018. Standard deduction jumped up to 24,000, so significant increase there, and the personal exemption actually went away. So let's talk about this in a little more detail. Standard deduction, again, for singles, went from 6,500 up to 12,000. Married, 13,000 up to 24,000. Personal exemption, that 4,050, that was repealed. So for people like myself who have 4 kids, I just lost $16,000 in deductions. So that's quite significant, right? And that's what a lot of the hoopla was at the end of the year, is okay, some of these proposals they are throwing around, they could be significant numbers.
Actually, you lost 24,000 people. Lost you.
What's that?
You mentioned for your wife as well, so you lost.
Correct, yeah. And so, and then you have people like Fabian, who he's having another kid here this year, all for the tax benefits, and that completely went away. So I'm not sure he knows what he's going to do now. So quick little trivia. It's estimated that what % of taxpayers will claim the standard deduction in 2018? And CPA, in case you've heard this, maybe. Anyone want to take a guess? It's estimated at 94%, and that's up from 70%. So it means most people moving forward will be taking that standard deduction, won't even worry about itemized stuff. So, but let's jump into a few of those itemized deductions and talk about some of the details. So first, state and local taxes. What are those? That's income, property, sales tax. That's now capped at $10,000. So that will significantly impact the residents of high income and property states like California, where you're paying an arm and a leg for your property tax as well as income. And that might even erase some or most of the benefits of those lower rates and brackets. So we'll go through a case study here in a couple of minutes to see what the impact is. Then we've got mortgage interest. Does anybody know out there, what was the allowable deduction for mortgage interest previous to 2018? You remember? What's that? Exactly, yep. So you could deduct interest on up to $1 million of principal. And on your HELOC, you could deduct the interest on up to $100,000 on your HELOC. So what's changed? Capped at $750,000, and that's on home purchases after 12, 15, 17. So if you don't plan on moving, you should be fine. But if you do plan on moving in the next few years, this is something you'll definitely want to take into account and will definitely impact your taxes. Charitable contributions. Previous law, you could deduct up to 50% of your AGI if you were a very, very charitable person. It actually has gone up to 60%. So if you want, you can deduct now up to 60% of your income. And another change is what has gone away is actually the right to deduct if you're making donations to purchase athletic tickets. So all of you SDSU alumni who have been trying to get those front row seats, not going to be able to deduct that. Other deductions, just quickly, that are disappearing.
Hey, Scotty,
yes.
Are you going to talk about?
I was not. Do you want to?
Finance a home now?
My understanding, yes.
Okay.
From my understanding,
The
what
old
has
loans are grandfathered in.
Yeah, and my understanding, what's changed is just on the HELOCs, where you can still deduct the interest on a HELOC as long as it is acquisition related, meaning it's on the purchase of the home or you're expanding the home. But previously, where you do like a refinance and start to consolidate all your debt into your HELOC, that is no longer tax deductible.
As long as there's no cash out.
What's HELOC?
Home equity line of credit. Sorry. So other deductions that are disappearing: casualty, theft losses, unreimbursed employee expenses, tax preparation fees, other miscellaneous deductions previously subject to the 2% AGI. So there's lots that are thrown in there, but not necessarily applicable to everybody. Moving expenses, some other employee subsidized parking and transportation that people would take. Those are all going away. AMT, fortunately not eliminated, but significantly. Okay, AMT, good point. Alternative minimum tax. Anyone familiar with alternative minimum tax? Some of you are probably in it, and that's where they go after the high income earners, where they're trying to some of those high income earners who get a lot of tax preference income. They try to take that away and level out their tax rate so that they're paying somewhere in the kind of the 25, 26, 28% rate. So that's the purpose of AMT. And when you're in California, where you're getting deductions for your mortgage interest, they have some other municipal bonds that's tax-free income. A lot of people in California end up falling into. But again, it's not eliminated, but it's actually going to drop, or they're estimating from having over 5,000 people affected by AMT down to 200,000.
5 million?
Or sorry, 5 million, yes. Correction. 5 million down to about 200,000. And the reason for that is, number one, the exemption increased. So singles, the exemption has gone from 55,400 up to 70,300. So you're not affected by AMT until you hit that 70,300. And then on the married, it goes up to almost 110,000. But more importantly is the phase out. So singles now, the phase out doesn't occur. Previously it was at 123,000. Now it's at 500,000 before all those tax preference income items are going to phase out. And for married, it actually goes all the way up to $1 million. So most likely, most people are not going to be affected by AMT unless you have significant. Any other thoughts on the AMT? So then child tax credit increased from 1,000 to 2,000. So this is why it still makes sense for Fabian to have another kid, is because even though your exemption went away, the credit actually has doubled. So that's a nice benefit. And then the phase out on that tax credit also increased, went from 75,000 for singles up to 200, married up to 400,000. So most middle income families are going to be able to take advantage of those credits. And then for low income families, you can actually get a refund of up to 1,400 for if it's qualifying. So even if you don't pay any tax, you can actually get it back from it. And then 529 plans. So if you're doing a college planning, previously 529 plans were limited to post-secondary education expenses, meaning you could only use the money to pay for college. That's changed to where now it allows for payment of qualifying expenses for elementary and secondary. So if you want to send your kid to private elementary, middle, or high school, you can pull money out of your 529. You may not have a lot of time for that money to grow, but you can still pull it out, and the earnings are tax-free. There is a cap, though, on the elementary expenses at 10,000, but not on the. So now let's just walk through a case study. It's simplified, but still shows some of the effects of these changes in the tax law. First, we're going to assume you got a married couple with 2 kids. Their AGI is 200,000. So they were getting 16,200 on the personal exemptions in 2017. We're going to assume they were taking about 25,000 in mortgage interest, 20,000 in their state and local property taxes, income taxes. They were donating about 10,000 per year, leaving them with a taxable income of 128,800. Tax on that would be about 23,678. They get credits for the kids of 2,000, leaving with net tax of 21,678. So, effective tax rate about what, 11%. 2018, we're going to assume the same variables. AGI 200,000. Personal exemptions have gone away, so that's 16,000 of deductions that's gone. Mortgage interest, we're going to assume they stayed in the house. They didn't have to, they didn't lose any of their HELOC deductions. But on the SALT, the state and local, we're going to assume it's capped now at 10,000. That's the max deduction they can take. And we're going to assume that they are SBU alum. They had really nice seats for the basketball games, and so they lost 5,000 in charitable contributions. That's going to put their taxable income at 160,000. So that's over a $30,000 increase in their taxable income, right? Leaves them with a tax based on the new brackets and rates at $27,079, but they actually get an increase on the credits, and so that's where some of those deductions are somewhat offset, leaving them with a tax of $23,009. So taxes did go up by $1,500, but probably nothing compared to what we thought it was going to be at the end of the year. So, and even then, some of the deductions that you had previously, there's a possibility for some of those to be recharacterized. If you were borrowing money against your HELOC, maybe there's a way to recategorize that as that's if it's income, an investment property. There may be ways to recategorize that. So I don't think at the end of the day anyone's going to be significantly penalized, but at the same time it is going to take some creativity probably between you and your CPA to make sure you're maximizing your deductions so that you're not negatively. That I'm going to turn the time over to Fabian.
Right. You. So now we're going to take a deeper look at the corporate tax rate. So everything that Scott just talked about has what's called a sunset provision. That means that law is going to go away in 2026. It's going to go back to what it was in 2017. What I'm talking about does not have a sunset provision. So this is going to stay the law unless the law is changed. And does anybody know what the corporate tax rate was in 2017? Other than our CPA? Depends on your taxable income range, but you're right. Anywhere between 15% to 39% is what you're paying in taxes. What is it now under the new law? 1 across the board, so much simpler. So let's look at the effect. We have company A, let's say they have a taxable income of 100,000. In 2017, their tax liability would have been a little over 22,000. Under the new tax law, 21,000, so they save about 5.6% taxes. It's actually, if your income is anywhere between 1 and 90,000, you're better off under last year's tax rate. If you're above 90,000, you're going to be better off under the new tax laws. And the benefit increases drastically. Let's look at Company B. They have 300,000 in taxable income, so their tax liability this year compared to last year there's a 37% reduction. And with $1 million, your reduction is at 38. With 10 million, it's at 40%. So for most businesses, they're going to save between 37 and 40% in taxes for the new. Take a look at some pass-through entities. So what we just looked at was for corporations, C corporations. What are pass-through entities? Limited partnerships, S-corps, right? Sole proprietorships, limited liability companies, partnerships, and corps are the four main pass-through entities. With those, you don't pay taxes corporate level, but it's passed through to the owners of the company. So how did the tax rate change for pass-through entities? Tax rate? What Scott talked about, because it's the individual tax rate. So there is none at the entity level, but it's those individual tax rates. One exception, they have there's a new deduction on that pass-through income that can be up to 20%. So if you can take advantage of the full 20%, then let's say you have 100,000 in taxable income. Now you get the 20% deduction. The tax is only applied on 80,000. That depends on your business. So that percentage is anywhere between 0 and 20%, depending on your type of business, nature of your business activity, total income for the owners, and in some cases, how much the business pays its employees and how much property. So it really depends. For our business, Cornerstone, we're limited on the. Yes, question?
20% tax doesn't do it.
At 20% when calculated taxable income for the rate.
CPA, Kelly?
Really get into the weeds. Full 20 on the income. It all gets calculated both at the. But when you were to have the most simplistic situation, you would get 20% reduction in your net taxable income after taking your depreciation. Now, having said that, if your depreciation deductions drive your taxable income to near zero, 20% on zero is zero.
Yeah.
But to Kelly's point, it's really outside of depreciation. It's on deduction on other things.
It's essentially a phantom deduction that they're giving you to help compensate pass-through owners in a similar manner to what the C-Corps got in their big rate. That was the point.
So we decided not to go into details on the 20% because it's pretty complex.
If that was their goal, in reality, C-Corp's got 40% reduction. In reality, pass-through entity even close to that?
So theoretically, if all your income was considered qualified business income, which is the definition item for this 20% haircut, your maximum effective tax rate on that income is 29.6%. So if you compare that to a C-Corp, it's 21%. Now, C-Corps have two levels of tax, though, because you can't get the money out of a C-Corp without paying a second tax. So you have to keep that in mind.
We're actually going to look at that. So if we compare that, let's say we have a C-Corp and let's say the taxable income is 200,000. So what's the tax rate on that? Anyone remember? 21%. So they're left with 158,000. Let's say that's paid out to the owner. This is where double taxation comes in. Let's say the owner is in the 35% tax bracket for this portion. So he's left with a little over $102,000. Let's look at a pass-through entity, just LLC for an example. Same income, what's the tax rate at the corporate level?
21.
No tax for pass-through.
Oh, pass through.
So the 200,000 gets paid out to the owner, and let's say same situation, 35% tax rate. So he's left with 130,000. If he can take advantage of the full 20% deduction, then he's left with 144,000. So it would be somewhere between 130 and 144,000 compared to $102,700. So why then, if you look at that, why are there several pass-through entities that are now considering converting to a C-Corp? If you look at the numbers, it doesn't make any sense. Why would you do that? Any thoughts?
You don't need to take that money out, right?
That's exactly right, Marcus. With the C-Corp, you have the option to keep it in the company. So you can let that grow tax deferred, and then eventually when you take it out, depending on how you structure it, you may be able to take it out at capital gains rates. There are some business owners that are setting up a combination of the two, where they set up a consulting business. So they have the C-Corp as their main business, and their salary goes into their consulting pass-through entity, and everything else they put back into the business. So they get the best of both worlds. They get the pass-through entity tax on their income, and they save up money in the business. Next, we're going to talk about the estate and gift taxes. Estate and gift taxes are really two portions. You have the annual gift tax exclusion and the estate and gift tax exemption. The annual gift tax exclusion resets annually, where the estate and gift tax exemption, that's a lifetime exemption. Anybody know what the gift tax exclusion is for 2018?
15,000 per person.
That's right, 15,000 per person. So I can give $15,000 to Ron without any estate and gift tax implications. My wife can do the same, so we can give Ron $30,000.
What about my wife?
And we can
Another
give
30?
Barbara another 30, so $60,000 without any estate and gift tax consequences.
Bobby and your wife can gift as well, so.
No, he said that.
Right,
Yeah,
right.
you already-
That's how we
That's
get to
how we got
the
there.
60.
That's when we got to 60. Ron's very fortunate.
I am.
So,
What a friend.
so we do that for all of our clients.
I know.
So we can do this every year. The amount changes, and that's adjusted for inflation. That's another change that is not widely talked about. The way the inflation is calculated has changed. The inflation rate for tax purposes is going to grow more slowly than previously. Is that a benefit or a disadvantage?
Disadvantage.
Yeah.
Disadvantage means you have less money you can gift away, but also in your tax brackets, your bracket will not keep up with the raise in your salary, so you'll sooner pass into a higher tax bracket. That is a disadvantage.
Bobby, in your case, it will actually be above your salary increase. So
I'm a lucky man. So that resets every year. The estate and gift tax exemption is lifetime. So whatever you gift above the exclusion amount starts to eat up your lifetime exemption and gift tax amount. So let's look at that. Anybody know what the lifetime gift tax exemption amount was last year per individual? It was about $5.5 million. So for couples, that was almost $11 million. What is it now?
It's a double per person, double per individual?
It's 11.2 for individuals and $22.4 million for a couple. And these amounts are adjusted for inflation. In 2026, anybody know what it's going to be then? It's going to revert back. It's going to be more because of the inflation adjustment, but it's going to revert back to the 2017 numbers. What's the tax rate?
40%.
Right, that did not change. That stayed the same across the board. So let's look at a case study. We have Beyonce and Jay-Z. And let's say, hypothetically speaking, they have a net worth of $30 million. They do have 3 kids, and that would be Blue Ivy, Rumi, and Sir. And let's say they want to split their estate equally between their 3 children. So in an ideal world, they would all get $30 million each.
10 million each.
10, that's right. 10, not 30. So with the new estate tax law, you have $30 million, that's your estate. What's the exemption again?
Well, 11.2. No, 22.4 for the
22.4. So you're left with a taxable estate of $7.6 million. You pay the 40% tax on that. So then the estate that's left to pass on to your heirs, the remaining assets, is almost $27 million. So what that means is that there's a 4th child, and that's the government, that's going to get a little over $3 million, and each child will be left with almost $9 million. Had they passed away last year, instead of $3 million, the government would have gotten $7.6 million. But we have a client that passed away last year, and her tax liability is going to be over $2 million. Had she lived 3 months longer, it would have been 0. That's painful. That is painful. But let's look at reality. In reality, according to Forbes, less than a year ago, their net worth was estimated at over $1 billion. So with that, the 4th child, the government will get over $455 million, and each child will be left with less than $235 million. The government will get more than the individual child. And just a reminder, there is a sunset provision when this law will revert back to 2017. And with that, I turn the time over to Chris.
Okay, I'm going to talk about 3 different strategies as it relates to IRAs, and probably most of you have an IRA in one form or fashion. So the first one, let's talk about, and this one's pretty straightforward. There's going to be no real new vision on this, but just to reiterate, here are the assumptions. I've got $1 million in my personal trust. I got $1 million in a traditional IRA, $2 million total. I'm 70 years old. I'm not really 70, but let's say I'm 70 years old, and I'm going to take it out over the next 25 years till I'm 95. So what will happen over that 70 years is, based upon IRS formulas, tables, I have to take out a little bit now, and each year it gets more and more and more until we're going to assume at age 95 it's all gone. That's not really the case. You can stretch it out even further than that, but we'll make the assumption it's gone. So, and then last but not least, we're going to assume that you get 6% return on your investments. Okay, so those are the assumptions. And we are looking at tax-favored investments and those that are just ordinary income. So tax-favored investments would be those things that have capital gains, lower rate, depreciation that you can take against real estate, for example, tax-free munis. Those are tax-favored. And let's say that all in all, that ends up being at about a 35% tax rate. It's probably less than that. It's probably more like 30. But to be conservative, we assume 35%. Whereas on your ordinary income, we're assuming 45%. And this would include California, by the way. Here again, it's probably higher than that. But so, ordinary investments, tax favored. 2 different scenarios. Scenario 1, smart investing. I'm going to put the tax favored in my trust and the ordinary into my IRA. And why is that?
Because you don't have to pay the taxes.
That. But even if I put the tax, in scenario 2, I'm putting my tax favored here. In theory, they're taxed at 35%, but when I pull them out, even if it's tax-free income in here, it doesn't matter. It all comes out as ordinary. So this is not the way to do it. You want your tax favored investments in your trust, and you want your ordinary income investments in your IRA. I don't think there's any great revelation to that. But just to kind of show you what the end result is here. Oops. Did we miss something there, Fabian? We did. So it goes just like this. It starts right here and it comes up to here. So that you have $4 million if you do it the wrong way, as opposed to almost $1 million more if you do it the right way. Okay, no great revelation there. Now let's talk about taxable and considerations within an IRA, in your IRA. Oh, these are the results. Pretty straightforward. Putting tax favored investments in your trust is better, and the reason for that is you're going to pay much less taxes over time. All right, so now converting from a traditional to a Roth. Should we convert from a traditional to a Roth? Answers?
Your age, depending on your age.
Yeah, the answer generally is yes, with some few exceptions, but let's just take a look at this. Here are the assumptions. Start the same way. $1 million in my trust, $1 million in my traditional IRA. I don't have a Roth yet. I'm going to convert at age 70. I'm age 70. I'm going to convert. I'm going to pay it out over the same 25-year period, and we're going to assume the return on investments is 6%. Okay. What was I?
R&D.
Oh yes, and I already mentioned that on the R&D. Okay, this is to remind me that the R&D doesn't run out at age 95, but anyway, we already talked about that. So here's the 3 scenarios. No conversion. I just leave it on the traditional IRA. Second scenario, I convert 40% of it. Third scenario, I convert 80% of it to my Roth IRA. Here's the results. It's pretty significant. Now remember, your traditional IRA, you've got your trust, your traditional, and your Roth. The traditional is gone by age 95. So this is age 95. I've got about 4.4 million if I make no conversion in my trust. Here I've got about close to 5 million. Here I've got almost 5.5 million. Much, much better. But more than just having the extra money is the majority of it in this case is in a Roth IRA. So what's significant about that?
Not taxable when you take it.
I can pull it out with no tax, and I don't have to pull it out. There's no required minimum distributions. I can let it go on to my kids, at which point they'd have to start taking it out, but they're taking it out of tax-free. So it is a significant benefit generally to make the conversion. Why do people not make the conversion then?
Too old
Not necessarily. It's painful
to pay it up front.
Yeah, it's very painful to write a big check to Uncle Sam today. But the trade-off is you don't ever pay tax on that IRA again. And in the long run, it makes more sense to make that conversion. Now, you may be talking around about age-wise. It does make a difference. Oh man, for some reason,
That's
Fabian,
what
these
your
aren't
income levels are.
these aren't coming out. Yeah.
If you're making less as you get older.
Not sure.
you know,
Well, what you would see here is under scenario 3, you start with less money because I had to pay it out when I converted, right? But at about 15 years, there's a crossover point where you actually have more money and it's better money because it's tax-free money. It's growing tax-free, so it's much better having it in that Roth IRA. So if you were to pass away before that 15 years, it's still not a bad thing because remember, looking at it from your family's perspective, that Roth IRA continues on into their life as well. So it's still, maybe not for you personally if you go too soon, but you probably don't care if you're gone, right? But for your kids, it would be, or your heirs, it would be beneficial. So as a general rule, making that conversion from a traditional to a Roth makes a lot of sense. We already talked about this. Converting as much as you can yields the best results. However, I will say something here. I wouldn't convert at all. Why not convert at all? Any thoughts on that? Well, first of all, my third analogy here is going to help make sense on that. But Also, if I convert it all and I have a low income tax year, for whatever reason, I gift a ton of money away to charity, my investments do terrible, I don't make any money, I then would want to pull it from my traditional, because now I can pull it out at a very low tax bracket. If I converted it several years earlier, like today, I'm going to be in a high bracket. And even though as a general rule that makes sense, if I convert 100% of it, I have no flexibility to then pull either from my traditional or from my Roth. That makes sense? So usually we wouldn't recommend converting any more than 75, maybe 80% of your IRA from a traditional to a Roth. You pay much less taxes over time, and you'll end up with a much larger amount in the Roth, which has significant benefits. It's growing tax-free. There's no required minimum distributions, and so on and so forth. All right, third strategy, and this is one that most don't think about: the proper placement of investments between a traditional IRA and a Roth IRA. Okay, forget the trust now. We're just talking about the two IRAs. Assumptions: you still got $1 million in your trust and $1 million in your traditional IRA. Now, from this traditional IRA, you're going to convert half of it. $500,000 is going to go into a Roth. You're going to pay the taxes. You're going to pay it out of your $1 million in your trust, and you're left with $500,000 in both your traditional and your Roth IRA. The overall return is still 6%. However, the return can vary within investments. So 3% and 9% average to 6. Does that make sense? We're still earning 6, but we've got 3 different kinds of investments. And let's make the assumption, this is not always the case, but as a general rule over time it is, that the more aggressive investments do indeed yield a higher return. So, for example, here are your investment returns: 3%, 6%, and 9%. These are your more aggressive investments. Should do better over time. Your much lower return, more conservative investments. Where do you want to put your more conservative investments between a Roth and a traditional IRA? More conservative, these investments, where do you want to put them? Which one? Traditional IRA is the right answer. Do you know why?
Well, because then you won't have to pay tax.
Growing slower, that's right. Whereas this, it's growing faster, you pay no tax. Exactly. Okay, so this is what we're investing in. Scenario 1, we're going to go 50-50. 6%, we're using the same investments in both the traditional and the Roth. Scenario 2, we're going to do it the wrong way and put our aggressive investments in the traditional and our least aggressive investments in the Roth. And in scenario 3, we're going to do it the right way. Traditional investments have the lower returns. Roth has the higher returns. And here's the results, and it's pretty staggering. $5 million, if you go half and half, about $600,000 less. And look at this, if you do it the right way, almost $7 million, almost $2 million more. And once again, the majority of your money is in that Roth IRA, which you can pass on to yours, and they can pull it out tax-free. You can pull it out tax-free. No minimum required minimum distributions. Total flexibility. This is very, very powerful, and a strategy we try to implement with our clients. And you did get the lines on this one, so you can see the lines. Okay. So the results: more aggressive investments in your Roth IRA gives the best results. You're going to pay less taxes over time. That's the reason, because you have the lower investments in your traditional, and you have a significantly larger amount in your Roth IRA. Takeaways. So the 3 things we looked at is what we learned. Put your investments with ordinary income in IRAs and tax-favored investments in your trust. Okay, it's pretty straightforward. Convert as much as you can, maybe up to 75% from your traditional to your Roth, and this assumes you've got money, liquidity. You don't want to drain your liquidity to zero, but if you got plenty of liquidity, it's painful, but write that check to Uncle Sam and be done with it. And and then put your more, and actually with the new tax law, this comes out much better because we're losing deductions, but when you're converting significant amounts into IRA, you're gonna get those higher rates, and the rates are now lower than they used to be. So it's much more powerful doing it this year. It's good you waited. And then put more aggressive investments in the Roth and the less aggressive investments in the traditional. That makes sense? A couple other considerations. We already talked about this. Pay your taxes from your personal portfolio. You may want to convert over several years because you can, if you can convert over 2 or 3 or 4 years, you might be able to keep them in that lower bracket by doing as such. So you just want to talk to your CPA and have them run some tax projections on that. And UBTI can be a problem. We're not going to talk about what UBTI is. I will tell you what it is. It's unrelated business taxable income. And probably the only person in this room besides those at Cornerstone that know what that is maybe Pete and a couple of other you. But it can be very devastating. It's not a good thing. And so depending on how you put investments in your IRAs, can generate UBTI, and you want to try to avoid that. It's not necessarily horrific if you don't have too much of it, but that's one you just have to be very, very careful of. And we're very familiar with that because it's the investments that drive the UBTI. So we know with all of the investments that we make for our clients whether it drives UBTI or not. And I'm with Pete, correct me if I'm wrong, most CPAs don't even see this or think about it. In fact, most of the K1s that we get, even though there may be UBTI, they don't check the proper box. So, and if they don't, then the IRS won't know about it. But if they do, you could be in trouble. So, all right.
So next we're going to talk about a few tax efficient investments you may be familiar with, some you may not be as familiar with. First one, tax-free munis. The benefit there is you're investing in particularly investment grade bonds, but you're getting a tax-free income source, especially if you're buying bonds that are sourced from where you live, such as California. And so that's a great source of income. And next one, master limited partnerships. A master limited partnership is a preferential structure typically used in the energy space. So energy companies set up these MLPs. And the benefit there is, as they're making a distribution, typically in the 6-7% range, that distribution is coming out and for tax purposes considered a return of capital. And so for the most part, it's tax shelter. About 80% on average is coming out tax-free. It's going to decrease your basis, so you could end up with a tax situation down the road when you want to sell that asset. But it can be very efficient for current income tax purposes. It can actually also be a great estate planning tax play because if you depreciate your basis and then you continue to hold the asset until, say you're a married couple and one of you passes away, you then get a step up in basis. And at that point, you effectively have gotten all of that income tax-free. And so you just have to know what you're getting yourself into, be able to manage it. It actually has been maybe a difficult strategy over the last few years because if any of you have had energy in your portfolio, has energy made you any money over the past few years? It hasn't. It's been, while the stock market has come back, the energy sector has stayed pretty much flat and actually probably still down a little bit. And so there's been a lot of volatility. And so holding on to those assets, has been a little bit of a struggle over the past few years and can be a little frustrating now. If you want to sell them off, you may actually be facing a pretty large tax bill. So you just have to know what you're getting yourself into. Oil and gas, obviously also energy, but this is a different structure. With oil and gas deals, they actually allow you to deduct in the first year much of the exploration and implementation costs. And so, let's say you put $100,000 into an oil and gas deal, you could probably actually deduct almost 90% of that in year one and offset that against other income gains. And so, not necessarily the greatest investment, and you don't want to go into investments purely for the tax ramifications, but it's something that does have beneficial tax aspects to it. And then lastly, we've already talked about this a little bit, is depreciable real estate. And so, income producing real estate may be giving you a 5, 6, 7% yield, and because of possible underlying losses on that real estate and the depreciation, you may be getting that 5, 6, 7% pretty much tax-free. And so that can be a great source of income. Again, you may have to recapture some of that depreciation down the road, but then there's also, maybe you've probably heard about 1031 like-kind exchanges. And that's where you can eventually sell your piece of real estate, roll into a new piece that's more desirable depending on your phase of life, and you can carry over your basis and not have to pay the taxes into that next piece of real estate. So another way to get current income without having to pay a significant amount of taxes. And so now let's just talk about various asset classes that we use and the target returns, and then how those returns are taxed. And so we already talked a little bit about bonds. They have a target return of 3%, cash flow about 3%. All that's going to be taxable unless it's a muni bond. If you're investing in corporates or federal bonds, it's all going to be ordinary income. High yield bonds, typically you're going after maybe an 8% return. You're going to get probably 6% cash flow, which is all going to be ordinary income, but you're typically trying to buy high yield bonds at a discount, trying to get some appreciation over time to get that 8% return. And REITs, that's where you're investing in real estate through publicly traded entities. Again, going after about 8% return. Cash flow is probably about 5%, which is for the most part going to be ordinary income. They can have structures where it's a dividend. There's some preferences to it, but we're just going to assume it's ordinary income. And then you get maybe 3% in appreciation over time as the real estate appreciates. Stocks, we're probably going after a 10% return. You're getting a dividend yield at 2%, which probably has some tax preferences, qualified dividend rates. So that's that 2% and the 8% appreciation, which would be capital gains. Private debt, that's where we're going into bond-like investments, but it's all privately traded, and actually not really even traded, it's just privately held. You're going after a 10% target return. That's going to be 10% cash flow, and that's all going to be ordinary income. And then real estate, probably going a little higher return, maybe 12% total, 6% cash flow. You may have some ordinary income on that, but hopefully in the first few years, most of that is going to be sheltered because, again, of the depreciation, maybe some business losses. And so you're going to get mostly capital gains treatment at the end. And lastly, private equity, you're going after the home run returns, 20% plus. Probably not going to see any cash flow, ordinary income, and expecting hopefully capital gains and not losses. And so that's tax characteristics from an asset class perspective.
So now we're going to take this kind of concept and tie it into the three things, what I talked about on the IRAs and how you make the investments on the IRAs. All right, so best vehicle for where you're going to put in your trust, your traditional IRA, and your Roth IRA. And we will be asking for answers. If you get the wrong answer, you're excused. Sorry. So these are the various investments, similar to what Scott talked about, only these are specific strategic partners that we are using and that we have experience with. So on Len Templeton, who's our bond guy, who's just incredible. We'll talk about his performance in the past, but he's been fantastic. He'll probably do much better than this in general, but as a general rule, remember Scott talked about 3% return on California tax freeze, no income tax. Green represents very good, like it. Yellow's going to represent it's okay, and red is bad from a tax standpoint. Corporate bonds, targeting a little higher return, but 100% of that's going to be taxable. No capital. Here again, you can still get capital gains off this, but we're not going to consider that. Stocks, I've been a little bit more conservative than Scott here. I'm assuming 7, 8%, whatever. But a little less than a third of that is going to be about a fourth, maybe a little bit more. It's going to be ordinary income, your dividends. Well, some of those can be capital gains as well, and 3/4 of it capital gains. PIMCO Flexible Income Fund. This is a fund, kind of a debt fund, targeting 9%. Most of it's going to be ordinary income, a little bit of capital gains. Greenbacker Energy. This is renewable energy, similar to the MLPs. And this is a fund that we're looking at right now doing due diligence on. We'll say target about 10%. The first 10 years, I believe, that comes back tax deferred in the sense that it's return of capital. So I'm paying no taxes. And upon sale, trying to get 100% capital gains. And if you hold it long enough, as Scott talked about, you get to step up in basis from if one of the spouses dies, that goes to 0. Virtu Energy Evergreen Fund. Any of you who've been clients at all will know the name Vertu. I've been doing business with them since the day I started the company, and have done a fantastic job. Let's assume a 12% return. A lot of that's going to be tax sheltered in the first few years, but let's assume about 17% is ordinary, the rest of it's capital gains. Now, in their evergreen fund, what they're doing is when they sell within the fund, they're going to 1031 that exchange, 1031 it for as long as they can. These guys, we've been doing business with them for almost 20 years. They're still in their early 40s. I started with them when they were very young, and they've done a great job. So they'll be with us for a long time. And if one of the spouses dies, all of that gets stepped up in basis, and you pay no taxes. So that's what they're attempting to do, and we really like that fund. Parkview, the loan on real estate, target of 13%. They've actually been doing a little bit better than that. All its ordinary income. Mobile home parks, 20% ordinary, most of it capital gain. And Greg Lansing, Kelly Burt back here, Reno stuff, it's all capital gain. All right, now, here's the test. Where am I going to put my tax-free munis? My trust, my traditional IRA, my Roth IRA. And if you do get this one wrong, you are getting kicked out.
Trust.
In the trust, of course. It's tax-free. You don't want to put it in here because you don't pay tax on it. How about corporate bonds? 100% ordinary income.
IRA.
Which IRA?
Well, Roth is always preferred if you have.
Not necessarily,
Okay.
because you've got a low return. So remember, your conservative investments, you're going to want to go in your traditional IRA because it's going to grow slower. So as you pull the money out, there's less money to pull out, and over time you will pull out less taxes. Keep giving myself away, but keep the higher returns more for your Roth
Can
IRA.
I stay? Do I have to leave?
Because you come every time, I can't kick you off.
Oh, thank you.
Stocks. Where are you going to put your stocks? Your trust, traditional IRA, probably, trust, although you don't want just bonds in your IRA probably, so a lot of people do stocks and bonds in their IRAs, so that might be the second choice. PIMCO Flexible Income Fund, most of it's ordinary income. Probably going to want it in my traditional, maybe my Roth, because it is a higher return. So if I have a choice between PIMCO fund or the corporate bond fund, I'm going to put my corporate bonds here with the lower returns and the higher returning investment in my Roth IRA. Is this all making sense? Mm-hmm. Yeah. Greenbacker Energy Fund.
The trust, yeah.
Probably the trust because, yeah, now you could go with the Roth because it's a higher return. So part of it's going to depend on the mix you already have and what you're doing in your portfolios, of course. So, but you probably would not put it in the traditional IRA. But here, because I can get 10% for the next, 10% without paying any tax for the next 10 years, that looks pretty good. For two, probably going to go with the trust, just because, especially with their evergreen fund, because their idea is to really postpone those taxes for as long as they can and just turn it into a cash flow vehicle that continues to increase year after year after year. So that, 10, 15 years from now, you're pulling 15% off that original investment. Parkview. This one's kind of a no-brainer here. It's all ordinary income, and it's a high rate of return. It's ideal for your Roth IRA. Mobile home parks. This one probably your Roth because of the high return, but it's not bad in the trust either because you get those tax advantages are good. And then Lansing real estate. This is developmental real estate, raw land. Probably going to go in the Roth just because the return's so good, but you do get capital gains. Now, living here in California, this capital gain, as good as it is on the federal side, you get no benefit on the California side. And so you're paying a 13+% rate. So for that reason, if you can throw it into, it may make more sense in the Roth. So, any questions on this? It's very powerful. You need to think about how you want to make your investments in your traditional, your Roth IRA, and your trust. All right, that is it, and we are at about 10 after. Got a couple of minutes if you have any questions at all on any of this. We'll take a couple, and then we'll stick around if you have any questions. or did we answer every single question you have?
Is there an advantage of giving money to a charity, as part of your, required minimum distribution from an IRA, as opposed to taking the money and then making a contribution?
Pete, you can probably answer that. Giving it directly to an IRA versus taking it and then, and to a charity, as opposed to taking it and giving it to the charity, is there any? Because you're getting the deductions.
Yeah, because when you take it as, well, if you're taking it from a traditional account.
Yeah, you wouldn't want to take it from.
It increases your
no.
AGI,
Yeah.
which then historically has triggered all kinds of phase outs and
That's a good
all
point.
that. So that would be the reason for not doing it that way.
So,
You do it direct.
yes, going direct, some of the phase outs on the medical deductions and the other Schedule A deductions, that would be a reason. Hadn't thought about that. Good question.
You just need to run some projections with your CPA. I mean,
Yeah, exactly.
Most likely they're going to be able to factor all that in and tell you where you should be with regards to charitable contribution. But you can always carry it forward.
Yeah.
You just may not
You
be
get
able
away
to
more than
maximize
60%.
it and use it in the year that you make it.
Now, here's a question. If it's your Roth IRA, which way do you want to do it?
Out of the trust.
Yes, you want to take the distribution because you're paying no tax and then pay. Although, if you pay from a Roth to a charity, do you get a deduction?
I don't think so.
Yeah, so you're going to want to take it out of your Roth because there's no income. Take $100,000 out of my Roth, give it away. I now have a $100,000 tax deduction. So from a traditional, probably better go direct. From a Roth, you're going to want to take it and then pay it to the charity. Any other questions? Yeah,
you discussed not having a deduction for football tickets to your alma mater, for example. What about scholarship donations to your alma mater?
Those are probably still fine, right?
It's a 501c3.
Yeah, those are still fine.
Typically should have set up.
And if they happen to give
And they
you
just-
tickets on the side, I'm sure there's gonna be some backroom deals going on.
There are a lot of universities that do that right now.
Oh yeah. How painful has it been that they can't deduct the CPA deductions now? The fees. Have you gotten any backlash on that at all?
Not so far.
Yeah.
I mean, nobody is really going to completely understand all the impacts to them until they do their 2018 return.
Yeah.
So one of the things that we try to do with clients who are paying us is if they have some sort of business interest of any sort going through their
we do the same thing.
we assign those fees to the complexity involved in doing the business work through the return. And so that's where the fees get deducted against the business income. They don't all hit on Schedule A.
Yeah, but if it is Schedule A and I no longer get a deduction, Pete's willing to lower the fee accordingly, so I net out.
Right.
Work is work.
That's because he's gifting me $15,000.
Exactly. Any other questions? Well, there's a lot to cover. Hopefully you learned something to take away from here, but thanks for coming. And next month, what are we doing? Bobby, is it
Mobile home park?
mobile home park?
Yeah, we have some activity in the fund to come back and give an update.
Great. Yeah, that's been a real great investment for us. Mobile home parks is a
Quick
big winner.
question for you about
I heard somewhere that they're gonna allow you to start taking deductions immediately for home improvement. Am I right on that? Home improvement, are they taken upon the sale of the property, or can they be taken immediately? Well, that's what I thought. Okay, thank you.
That would be great.
I know.
From the deed to shopping insurance, you get any write-up for the?
Well, you get a write-out, it's just not deductible.
You can say away your traps.